Huge profits, but no cash. A 35% revenue CAGR, yet free cash flow is deep in the red. Welcome to the curious case of Hariom Pipe Industries, where integration is a strength, but working capital might be its biggest risk. In today's video, we uncover the real story behind a steel pipe manufacturer that's grown 15x in 9 years, and ask, is this growth built on fundamentals or financial friction? Let's decode it, step by step. Let's start by understanding what Hariom Pipe Industries really is, and why it stands out in the crowded cyclical steel sector. At first glance, it's just another pipe manufacturer. But look deeper, and you'll see a vertically integrated value chain, smart capital use, and a company that's quietly grown 15x in revenue over 9 years. Here's the story, from trader to manufacturer. Hariom Pipe Industries began in 2007 as a steel trading business in Hyderabad. Over time, it evolved from a middleman to a fully integrated manufacturer. Today, it makes everything in-house, from raw sponge iron to billets, to pipes, to scaffolding systems. That means no outsourcing, no middle layers, and much better control over quality and cost. This vertical integration is their biggest strategic strength. By producing their own raw materials, they insulate themselves from steel price swings that hurt competitors. 4 plants, full control. The company operates 4 manufacturing units across Telangana, Andhra Pradesh, and Tamil Nadu. These plants are close to iron ore sources and key industrial hubs, reducing freight and logistics costs. Their facilities include sponge iron kilns, steel melting shops, pipe mills, a galvanizing unit, and solar power setups. It's like a steel ecosystem, under one brand across one belt of India. Business segments, value-added focus. Hariom operates in 2 main verticals: iron and steel. Billets, structural steel and pipes and scaffolding. MS pipes, GI pipes, solar mounting structures, and shuttering plates. Over 97% of their current revenue now comes from these high-margin value-added products, up from just 14% in FY20. That's a massive product mix shift in just 5 years. And it shows in the margins. Value-added products mean higher pricing power and better profit per ton. Distribution and market reach. Hariom sells its products through a strong B2B and B2C hybrid model. It has over 800 active dealers, 500+ retail touchpoints, and presence in 10+ Indian states. They're expanding aggressively into North and East India, beyond their stronghold in the south. Their customer base spans construction firms, water infrastructure projects, and solar EPC players. That's strategic diversification, not dependence on any one industry. Strategic philosophy. Discipline over drama. What makes Hariom different isn't just growth, it's how they've grown. They've avoided unrelated business expansions. They've kept debt low. They reinvest profits, not dilute equity. And every part of their value chain adds strategic advantage, not just size. In peaceful investing language, this is a business that doesn't chase headlines. It builds quietly, efficiently, and with purpose. To sum it up, Hariom Pipe isn't just manufacturing pipes, it's building a self-sustaining, capital-efficient steel ecosystem. And for investors who seek long-term clarity, this is where the real story begins. Let's now study Hariom Pipe's financial performance over the last 9 years, from FY17 to FY25. This is where we stop looking at headlines and start looking at habits. Revenue growth, 15x in 9 years. In FY17, Hariom Pipe generated just Rs 87 CR in sales. By FY25, it's clocking Rs 357 CR. That's a growth of 15 times in just 9 years, or a compound annual growth rate, CAGR, of over 35%. This kind of growth is rare, especially in a capital-heavy, cyclical industry like steel. And it wasn't driven by frequent equity dilution or unsustainable debt. Most of the growth came from expansion into value-added products, like galvanized pipes and scaffolding, and from integrating its raw material production in-house. Profit after tax, Rs 62 KR in FY25. PAT, or profit after tax, grew from Rs 6 KR in FY17 to Rs 62 CR in FY25. That's nearly 40x growth. Hariom managed to stay profitable every single year. Even during steel price volatility or when major capex was underway, the company never dipped into losses. This kind of consistency is a good sign of operating discipline. Operating profit margin, OPM. Stability in a volatile industry. Hariom's OPM improved from around 7.7% in FY17 to about 12.9% in FY25. That's a strong performance, because steel is a low-margin business by nature. Why did margins improve? They moved up the value chain, produced raw materials in-house, reduced power costs with solar capex. So instead of being just a pipe seller, they became a pipe maker, billet maker, and even a power generator. That's vertical integration, and it protected their margins. Return on capital employed, ROCE, from strong to moderate. ROCE tells us how efficiently the company uses capital to earn profits. Hariom had excellent ROCE in earlier years, as high as 26% in FY22, but in FY25, ROCE dropped to around 12.3%. Why? Because they made big investments in new plants, and those assets are not yet fully utilized. This isn't a bad sign, but it means the company must now deliver returns on the money it has already spent. Return on equity, ROE, still strong. ROE was around 27% pre-IPO, but has now moderated to 11.9% in FY25. Why the drop? Simple. The equity base expanded after the IPO, and the new capital is still in the process of generating full returns. As utilization increases, ROE should rise again. But investors must track this number closely. One major red flag, FY23 cash flow collapse. In FY23, Hariom's cash flow from operations turned negative at Rs 100 CR. That wiped out years of gains. This was likely due to a build-up in inventory and receivables during expansion. The good news? FY25 shows a recovery, with Rs 79 CR back in positive cash flow. But this incident reminds us, rapid growth can strain the engine. Cash flow is the pressure test. Summary. Hariom's financials tell a story of solid growth, smart reinvestment, and consistent profitability. But they also flash a warning that working capital efficiency must now catch up to revenue growth. In peaceful investing, growth is good, but only when it's backed by free cash and strong returns on capital. Hariom passes the growth test, now it must pass the cash test. Let's now focus on something many investors overlook: cash flow. You've seen the profit numbers, Rs 62 KR in FY25. Great, right? But here's the uncomfortable truth. A business can show profits and still struggle to pay its bills. Why? Because profits on paper aren't always cash in the bank. So now let's ask the deeper question. Is Hariom Pipe actually turning those profits into cash? The basics. What is cash flow from operations, CFO? Cash flow from operations, or CFO, tells us how much actual cash the company generates from its core business, not from selling assets, not from raising loans, but from day-to-day business, making and selling steel, collecting payments, and paying suppliers. In the peaceful investing framework, a high-quality business consistently shows CFO that matches, or even exceeds, its profit after tax. Hariom's shocking CFO reality. Let's look at the numbers. From FY17 to FY25, Hariom Pipe generated Rs 236 CR in total profit. But its total CFO in this same period, just Rs 14 CR. That means for every Rs 1 of profit, the company generated only Rs 0.06 in cash, 6 pays on the rupee. That's extremely weak. This isn't just a bad year. This is a pattern. So where did the cash go? The answer is working capital. Working capital, the cash trap. Working capital is the money tied up in inventory and receivables. Inventory is unsold products sitting in warehouses. Receivables are sales made, but money not yet collected from customers. If these two balloon, your profits are stuck in the system, not in the bank. In Hariom's case, receivables rose sharply in FY24 and FY25. Customers took longer to pay. Inventory also piled up due to expansion. This combination choked the company's operating cash. Capex and free cash flow, the real test. Now let's talk about free cash flow, FCF. This is the cash left after the company spends on new plants, equipment, and infrastructure, called capital expenditure, or Capex. Free cash flow =CFO CAPEX. Between FY17 and FY25, Hariom's total CAPEX was about Rs555 CR. So if we subtract that from their Rs14 CR CFO, we get a total free cash flow of Rs541 CR. That's a huge cash gap. It means the company is spending far more than it earns, and funding that gap using external sources like IPO proceeds or debt. This isn't necessarily fraud, but it is financial friction. If this continues, growth becomes dependent on outside funding, not on internal strength. The bright spot, FY25 recovery. There is a positive sign. In FY25, CFO jumped to R79 CR, one of the highest in the company's history. This suggests early signs of recovery. Maybe inventory is being sold, maybe receivables are coming down. But one good year doesn't fix 8 weak ones. Summary. Here's the peaceful investing view. Hariom is profitable, but it hasn't consistently generated operating cash. Free cash flow is negative. It must now shift from expansion to consolidation and start harvesting the returns of its investments. In simple terms, it's time to stop spending and start collecting. Until that happens, investors should track cash flow metrics more closely than profit. Because as the saying goes, profits are opinion, but cash is fact. Let us study now self-sustainable growth rate. Can Hariom Pipe grow without borrowing or diluting equity? That's where self-sustainable growth rate, or SSGR, comes in. SSGR tells us how fast a company can grow using only its own retained earnings. From FY19 to FY25, Hariom's SSGR averaged about 23%, with peaks above 30% in FY23 and FY24. That's respectable, showing decent internal strength. But here's the twist. Actual sales growth was 35% SAGR, well above its SSGR. This gap confirms that the company leaned on IPO funds and debt to scale faster than its cash engine could support. In FY25, SSGR dipped to 17.6%, even as PAT stayed strong, likely due to either lower reinvestment, dividend outgo, or early signs of margin pressure. Bottom line, Hariom has shown organic muscle, but not enough to fully self-fund its rapid growth. That's okay, if the CAPEX now starts paying back. As investors, we should watch whether future growth comes more from cash flow and less from capital markets. In a commodity business like steel pipes, how do you stand out? Hariom Pipe's answer: own the value chain, own the cost. Their backward and forward integration is the backbone of their strategy. From producing sponge iron and billets in-house to rolling out galvanized pipes, scaffolding, and even solar infrastructure frames. This gives them control over input costs, better quality consistency, and protection against raw material price swings. In simple words, less dependence, more resilience. They've kept debt low, logistics tight, and avoided unrelated ventures. That's rare discipline. While competitors focus on pipes alone, Hariom spreads across billets, structural steel, and high-margin galvanized products. Their EBITDA per ton ranges between R7,000 to R9,000. That's well above peers stuck at RS5,000 to RS7,000, and they're expanding smart, growing beyond Telangana and Tamil Nadu without burning cash or overextending. Their strategy is simple: integrate smartly, price competitively, and keep margins steady. Even in a volatile industry, even great businesses can be destroyed by poor management. So how does Hariom Pipe fare on governance? Actually, pretty well. The promoters hold 66.7% of the company, and none of it is pledged. That's skin in the game, not borrowed confidence. The founding team, led by Mr. Hariom Golas and second-generation director Suraj Golas, has shown strategic clarity, especially in expanding without unrelated diversifications. There's been no excessive promoter salary, no questionable related party transactions, and no board instability. Independent directors with finance and legal experience serve on all key committees, and audit trails have been clean across the last 3 years. Post-IPO, they've delivered on every capital deployment promise, from new plant setups to solar projects. Peaceful investing's governance checklist, clear tick marks on all key points, no pledging, no misuse, full disclosure, and strategic alignment. In a mid-cap steel company, that's not just rare, it's refreshing. Let's now understand how Hariom Pipe Industries has used debt over the years, and whether its financial foundation is strong or shaky. In investing, this part is called leverage analysis. It tells us how much the company has borrowed and how safely it can repay those loans. Leverage means using borrowed money to grow a business. It can help companies grow faster, but too much of it is risky. In peaceful investing, we prefer companies that grow with their own money, not through constant borrowing. The key ratio we use to measure this is debt to equity, DE. A DE above 2.0 is considered risky. A DE below 1.0 is considered safe and manageable. In FY17, Hariom had a debt-to-equity ratio of 2.56, meaning it had RS2, 56 in loans for every RS1 of shareholder capital. That's high, and it suggests the business was dependent on lenders. But by FY25, this came down to just 0.70. That means Hariom reduced its reliance on debt, a strong and deliberate move toward financial health. How did they do it? They used profits to pay off loans. They raised money through their IPO, and they didn't take on new risky borrowings. This is exactly the kind of financial behavior peaceful investing supports: responsible, long-term, and low risk. Next, let's see if Hariom can comfortably pay the interest on its loans. We use a metric called the interest coverage ratio, ICR, which tells us how many times the company's profits can cover its interest expenses. If ICR is below 2, it's risky. Profits barely cover interest. If ICR is above 3, that's comfortable. Hariom has maintained an ICR above 3.0 in every year, and in FY25, it was 3.78x. That means for every RS1 in interest, Hariom earns RS3, 78 in operating profit. This shows that even with its loans, it's not under pressure. Credit rating agencies like ICRA have given Hariom a rating of A or stable. That's considered an investment-grade rating, a sign of trust from professional debt analysts. Also important, Hariom has no pledged promoter shares and no promoter loans hidden in the books. This tells us two things. Promoters are not putting the company at risk to fund personal or unrelated ventures. The business is being run with clear boundaries and financial discipline. Hariom Pipe started off as a heavily borrowed company, but today it has reduced debt, increased profits, and is comfortably managing its financial obligations. In peaceful investing terms, this is a low-leverage, high-integrity balance sheet, and that means the company has room to grow without worrying about loan defaults or sudden financial shocks. For investors, that's one less risk to lose sleep over. Let's now explore the engine that keeps daily operations running: working capital. Think of it like fuel for the business. It keeps inventory moving, helps collect payments, and pays suppliers on time. But when working capital becomes inefficient, even a profitable company can run into cash problems. So let's break it down in a way anyone can understand. Working capital is the money a company needs to run its day-to-day business. It mainly includes receivables, money owed by customers; inventory, goods waiting to be sold; payables, bills the company has to pay. The formula is working capital = current assets, current liabilities. In peaceful investing, we look for efficient working capital, where the company collects money fast, doesn't hold excess stock, and manages its payments well. From FY17 to FY22, Hariom showed good discipline in working capital. Receivables were low, inventory turnover was healthy, cash flow was under control. This helped the company grow without stretching its cash too thin. But post-IPO, as Hariom expanded aggressively, things started to change. Receivables jumped. In FY22, it took the company 19 days to collect payments. By FY25, it takes 44 days. Inventory turnover slowed. Stock is sitting longer in warehouses, meaning more money is locked up and not generating returns. This increase in the working capital cycle means cash is moving slower through the business. And that's why the company reported weak or negative operating cash flow in several years, even though it showed healthy profits. Let's simplify 3 key ratios investors can track: receivables days, how long it takes to get paid. Peaceful investing likes this number under 30 days. Hariom, 19 days in FY22, 44 days in FY25 inventory days. How long goods sit unsold? If it increases, it ties up cash. Hariom's inventory days have gradually increased post-expansion. Payables days. How long the company takes to pay its suppliers. Hariom hasn't delayed payments excessively, a sign of supplier trust. So overall, Hariom is paying on time but waiting longer to collect and holding more stock. That creates a cash flow squeeze. This isn't a fraud sign, but it is a friction sign. If receivables stretch too far, the company may need to borrow money just to fund operations, even when it's profitable. For peaceful investing, this is a red flag. It shows that profits are not yet self-sustaining. Working capital should support growth, not block it. The good news: these problems can be fixed. Tighten customer credit terms, improve inventory planning, use digital systems to speed up collections. If Hariom can do that, its strong profit engine will finally reflect in its cash flows. Until then, working capital remains the missing piece in an otherwise well-run company. And in peaceful investing, we don't ignore the missing pieces. We wait for them to fall into place. Let us start now to study the dividend policy and capital allocation. In investing, how a company uses its profits is just as important as how much it earns. So what does Hariom Pipe do with its money? Short answer: it reinvests. Every single rupee. From FY17 to FY25, the company paid 0 dividends. Instead, it channeled earnings into capacity expansion, galvanized pipe plants, melting units, and captive solar power. And it stuck to its word. IPO proceeds were deployed exactly as promised. No deviation, no unrelated ventures. Now, how do we judge the quality of this reinvestment? That's where ROCE comes in. Return on capital employed. Hariom's ROCE peaked at 26% in FY22, but has since moderated to 12% in FY25, as new plants came online but haven't fully ramped up. This dip isn't a red flag yet, but the next phase must show operating leverage. Otherwise, reinvested capital starts to underperform. For now, it's a textbook case of disciplined capital allocation, but ROCE must bounce back above 15% for this growth logic to hold. A company can show profits, pay taxes, and still not be financially healthy. That's why we need forensic checks, to look beneath the surface of the reported numbers. Let's walk through this carefully, in plain English, even if you're new to investing. 1. Clean audit reports. For the last 3 financial years, FY22, FY23, and FY24, Hariom Pipe received a clean opinion from its statutory auditors. That means the auditors found no major errors, frauds, or inconsistencies in the financial statements. There were no audit qualifications, no resignations, and no forced restatements. That's a good sign. It means the accounting is transparent. 2. No promoter-linked red flags. Promoter holding stands at 66.7%, and more importantly, none of it is pledged. Pledging shares is like taking a loan against your own house. It's risky. But here, there's no such leverage. That's a strong vote of confidence. Also, promoter salaries are within SEBI-approved limits. No excessive bonuses. No signs of funds being moved around through related party transactions. The company isn't doing business with suspicious shell firms. It's not funneling money to family-owned entities. Clean governance? Yes. Now let's get into the real check. Are reported profits actually converting into cash? This is where red flags start to rise. Between FY17 and FY25, Hariom Pipe reported cumulative profit after tax, PAT, of Rs 236 kr. But its total cash generated from operations, CFO, just Rs 14 cr. That's a serious mismatch. In the peaceful investing framework, we want CFO to be close to or even higher than PATI over the long term. That means profits are real, not just on paper. But in Hariom's case, most of the profits are stuck in the business, tied up in unsold inventory and unpaid receivables. Think of it like this. Hariom is earning money on its books, but not collecting it in the bank. Now add capital expenditure, CAPEX, to the equation for new plants, solar systems, and infrastructure. When you subtract this CAPEX from already weak operating cash flow, you get free cash flow, FCF. And it's not pretty. Hariom has reported negative FCF of over Rs 541 cr across the last 9 years. That means they spent more than they earned and had to rely on IPO money and debt to fill the gap. This isn't fraud, but it is friction. The audits, governance, and intent look good, but the financial engine is under strain. Until working capital is tightened and FCF turns positive, this business isn't financially peaceful. In peaceful investing, cash is king, not just profit. And while Hariom passes the honesty test, it's still failing the liquidity test. So it's not about losing trust, it's about exercising caution. Now let's slow down and zoom out and score Hariom Pipe Industries across 15 critical checkpoints from the peaceful investing philosophy. These aren't just accounting ratios. They're a lens into business strength, balance sheet integrity, and management honesty. Let's evaluate one by one. Sales growth. 10% CAGR over 10 years. Absolutely. Sales grew from Rs1 to 21 CR in FY17 to Rs1 357 CR in FY25. That's a compound growth rate of over 35%. A clear pass, consistently positive PAT, profit after tax. Yes, the company has remained profitable every single year, with PAT rising steadily to Rs62 CR in FY25. Even in tough steel cycles, Hariom didn't fall into the red. Operating profit margin, 15% and stable. Here's where it slips slightly. Hariom's OPM has ranged between 11% and 14%. Not bad for a steel company, but short of the 15% peaceful investing benchmark. Still, consistency earns a neutral score. ROCE, 15% in most years. ROCE, return on capital employed, tells us how efficiently the company turns capital into profit. Hariom hit 20% plus in FY18 and FY22, but fell to -12% in FY25 as new capacity came online. Execution lag is understandable, but this must recover. RO, 15% and stable. Return on equity has remained strong, well above 15% for most of the decade. It dipped post-IPO as equity base expanded, but the quality of ROE remains intact. This is a serious red flag. Over 9 years, Hariom reported Rs236 CR in PAT, but only Rs14 CR in cumulative CFO. Profits haven't converted into cash, a core concern in peaceful investing. Unfortunately not. With capex-heavy years and weak CFO, Hariom has negative free cash flow of over Rs500 CR. That means external funding, not operations, are sustaining growth. Self-sustainable growth rate has averaged -23%, supporting approximately 15–20% organic growth. Although the company grew faster via IPO funds, internal strength is decent. Hariom raised money only once, during the 2022 IPO. Since then, no dilution, no rights issues. A very disciplined approach to capital structure. From a high of 2.5x in FY17, Hariom brought this down to 0.7x in FY25. That shows long-term deleveraging, not reckless borrowing. Another green tick. Hariom's ICR, the ratio of operating profit to interest cost, has consistently been above 3x. That means its profits are easily covering its loan obligations. Post-IPO, all funds were deployed towards promised projects, new plants, solar, expansion. No money was diverted into unrelated areas. Strong integrity here. Auditors gave clean reports. No issues flagged. No resignations or restatements. Promoters hold 66.7%, with 0 pledged shares. No unusual related party transactions. Transparency and alignment are evident. This is where the caution flag waves. Receivables jumped to 44 days in FY25, up from 19 days in FY22. Inventory turnover has also softened. This can choke liquidity and cash flow. 10 green, solid fundamentals and promoter discipline. 3 yellow, signs of efficiency drag that must be monitored. 2 red, critical cash flow weaknesses that block long-term conviction. According to Peaceful Investing, this is a company with potential, but not yet peace of mind. Fix the cash, tighten working capital. And this story could turn from cautious optimism to compounding conviction. Now let's step into the future. What are the levers that could drive Hariom Pipe Industries higher, and what could hold it back? This section breaks it down into 3 parts: growth catalysts, risk factors, and strategic scenarios. 1. Growth catalysts. What's working in Hariom's favor? First, their new galvanized pipe plant in Tamil Nadu is a game changer. As it ramps up utilization beyond 75%, it will drive both volume and margin without the need for fresh capex. Second, Hariom is moving from just pipes to value-added solutions, scaffolding, solar infrastructure, and structural steel. These products fetch better prices, reduce cyclicality, and diversify end-user industries. Third, their investment in captive solar power is quietly improving cost efficiency. In steel, where power is a major expense, this is a competitive edge. Fourth, their dealer network is expanding into Tier 2 and Tier 3 cities across North and East India. This unlocks new demand pockets, especially in rural infra, water pipelines, and housing. Together, these growth drivers create a runway, not just for revenue, but for better margins and return ratios. 2. Risk factors. What could go wrong? But of course, every runway has turbulence. First red flag, cash flow. Hariom's profits haven't yet translated into free cash. If receivables continue to stretch, liquidity could tighten, especially in a slowdown. Second, the inventory turnover has softened in FY25. If this trend continues, it could signal slower demand or inefficient stock planning. Third, steel prices are volatile. If raw material costs spike and finished goods pricing lags, margins could take a hit. Fourth, there's still a heavy revenue dependence on South India. If expansion into North and East stalls, growth may plateau. None of these are deal breakers, but they are factors investors must track closely. 3. Strategic scenarios. What could the future look like? Let's map 3 realistic outcomes based on execution, markets, and internal efficiency. Base case revenue grows steadily to RS1, 300 Rs1, 400 CR, operating margin stays around 13%. Working capital stabilizes and cash flow turns moderately positive. Stock performance mirrors fundamentals, slow, steady compounding. Upside case. The galvanized plant hits 90% plus utilization, receivables improve, and solar power savings boost margins. Revenue crosses RS1, 500 CR, and OPM hits 14.5% plus. FCF turns consistently positive. Market rewards with re-rating, a potential 2-3x opportunity over 3-5 years. Stress case receivables stay high. Capex returns remain delayed, and steel price headwinds hurt margins. Revenue stagnates near RS1, 200 CR. Margins dip below 11%, and cash flows remain choked. Valuations compress, and growth stalls. Which path Hariom takes depends not on external demand, but on internal execution. As of now, the business model is built. The balance sheet is healthier. The strategy is clear. What's missing? Cash-backed delivery. And until that shows up, this remains a watchlist stock, not yet a portfolio star. So what's the bottom line on Hariom Pipe Industries? Here's what we know. It's a capital-efficient, integrated steel player, run by clean, promoter-led governance, growing with discipline, not debt, shifting smartly into value-added, higher-margin products. It has every element of a long-term winner, except one: consistent cash conversion. Free cash flow is still deeply negative, receivables are rising. That's not a permanent flaw, but it is a current friction. So what should an investor do? Our view: don't rush, wait. Track these 3 metrics over the next few quarters. 1. Free cash flow turns positive. 2. Receivables drop below 30 days. 3. ROCE rises back above 15%. If these improve, and execution keeps pace, Hariom Pipe could emerge as a strong compounding story. Until then, let this stay on your radar, not yet in your portfolio. And remember, this isn't stock advice. This is a lens, a framework, a long-term way to think about businesses that build value over time. As the principles of peaceful investing remind us, conviction must be backed by clarity. If this video brought you clarity, consider subscribing, liking, and sharing it with someone who's serious about long-term investing. Because we don't just pick stocks, we decode businesses.